So today I'm going to talk about a couple super simple principles that I use in my portfolio. And the reason I created this presentation today was because last year at this conference, I got asked a ton of times from new investors who were here for their first time, how do I get started, right? How do I begin building a resource portfolio? And there's like 100 different ways, right, to do this. So I have my way. I'm going to share that with you. I'm going to share some of the things that I did when I started building my portfolio. And a lot of these, almost all of them, 4 to 5, I still do today. And the 5th one I probably should still do, and we'll talk about that. Today we're going to talk about 5 simple rules for every commodity investor. So the first rule is decide what kind of investor you are. And this expands far outside of the resource market. I think every investor should have this conversation with themselves and ask themselves what kind of investor they are. It's the most important question, and it's the question that nobody ever asks, right? Are you a long-term value investor? Are you a swing trader? Are you looking for yield and cash flow? What's your time horizon? What's your risk tolerance? All of these things are super, super important and help you make much better decisions when it comes to allocating cash. But most people never go that far, right? They just start throwing cash at ideas they think are good. That's not a strategy, right? If you get clear on exactly what type of investor you are, everything else becomes easier because this becomes a litmus test for all of your decisions. So how do you go about deciding what kind of investor you are? Here's what I would recommend. The first question you should ask yourself is, how much time do I have to invest in being an investor? And I don't mean just today, but I mean every day, right? Today, tomorrow, next week, next year, et cetera, et cetera. And the reason is because if you have half an hour a week, there's absolutely nothing wrong with that. If you have an hour a week, there's nothing wrong with that. But I might suggest that that's not sufficient time to be picking individual stocks. I don't know if that's enough time to make you competitive right there. And you want to find your competitive advantage. You want to play this game your way, right? You want to play with a winning strategy. You want to know what your competitive advantage is. If you got an hour a week and you think you're going to beat the market by picking individual stocks, I think you should have an honest conversation with yourself. I'm not sure that's possible, but it's a great amount of time to pick some passive products, maybe scale into index funds or ETFs and things like this. Now, I have about 2 hours a day for my portfolio. And after that, I have 2 businesses, 3 kids, life runs away. Now, granted, my business is related to the market, so I get more time than that. But 2 hours a day is ideal for me to be a long-term value investor. It's not enough time for me to be a swing trader and time sentiment in the market and how investors are feeling and what's being overbought and what's being oversold and reading volatility and all of this stuff. It's not nearly enough time for me to be a day trader, but it's perfect for me to find things that are cheap, buy those things, and then sell those things when they become expensive, which is at the core of value investing. Now, the reason that I stress finding your competitive advantage is because I like to think about this sort of like an arena. And whenever you're buying an equity, if you're buying a share in a company, you are having a disagreement with somebody. And we don't think about it this way. We think, oh, we're just trading shares, right? But you're buying something. And if you're buying something, that means somebody is selling that thing to you. So let's take a company like Tesla, for example. If you were just to go and place an order on your Wealthsimple or your Robinhood app and buy some shares of Tesla, that means that somebody else on the other side of that transaction disagrees with you about what's going to happen in the future of that company. Hopefully, you think this is undervalued and the price is going to go up. And that's why you're buying it. But you have to acknowledge on the other side of that transaction, there's somebody who says, I think it's overvalued and the price is going to go down, so I should sell it. If you can't ask yourself, what do I think I know that that person probably doesn't? If you don't have an answer to that question, then I think you should question what you're doing in that engagement before you square off with this other shareholder, right? So it's important to think about the market that way because this is a competition, right? That's what a free market is. When you get to the core of this, one thing you'll learn is your time horizon, right? A long-term value investor, I like to invest in a company personally, and I can sit there for 3-5 years. That's kind of where I sit. Now, the benefit of knowing what type of investor you are and therefore knowing what your time horizon is it gives you the durability to weather volatility, right? I don't know what the share price of a company is going to do in 10 days. I could never predict that, right? But I can identify long-term macro trends. Now, who was at my talk this morning? Was anybody there? A few? Okay, so I like to step back from near-term noise. Like I think about everything in my life this way. The market especially, it's so easy to get caught up in like near-term events and headlines and what happened yesterday and all this stuff. I like to step back and take a long-term view. So long-term value investing is like perfect for a guy like me. But when I'm clear on my time horizon, that just means that if I enter a position and I'm not immediately right, maybe a month later, I'm down 10%. And 3 months later, I'm down 15 or 20%. I don't have to freak out if my time horizon is 5 years and I already admitted to myself that I don't know what this short-term volatility is going to include. But over a 5-10 year time horizon, I know that we're short this supply and we're going to need more of it. And so I can sit back on my thesis and rest assured that this doesn't disrupt my conviction, right? Because my time horizon is much longer than the near-term volatility. Does that make sense? Okay. Rule number 2, I like a strategy called the barbell approach. Now, this takes a lot of discipline for me to utilize, but it's helped me tremendously. I have my portfolio divided into 2 sides. On one side is super stable, conservative, non-volatile assets, the boring stuff, right? Like cash and real estate and gold, things that don't really move that much in terms of price, but do a decent job at retaining purchasing power. On the other side, and I have nothing in the middle in the broad equities market. On the other side, I have super high risk opportunities like the companies out here in the junior mining sector. Now, the reason for this is I want to make sure that I can go into the high risk sector with confidence. And the only way I can do that is if I'm certain that if everything goes south on the high risk side of my barbell, that I've got enough on the stable side to sleep well at night, all right? Now, I don't play the middle of the market because I don't have a competitive advantage there. I can't outcompete you buying Tesla shares. I just can't do that. But I can hit this industry and do diligence on the people that run small businesses. I can put more work in than everybody else. And I feel like I can generate myself a competitive advantage to play in this sector where if you're smart, put the work in, and are a durable human being, you can uncover those 5x, 20x returns. And that's what I look for. I look for those asymmetric bets when I'm putting cash to work on the speculative side of my barbell. But on the other side, it's all about just retaining the wealth that I've built. And if I am fortunate enough to generate some wins on the speculative side, I pull those over and park them in the boring side. Now, at this point in my life, I have 3 kids, so my barbell is like 80% security. It's 80% boring stuff. Right? This is the war chest, right? The cash that I hope to never have to touch, but it's there just in case. 10 years ago, when I was single, footloose and free, no kids, I had a way higher risk tolerance and my barbell was skewed the other direction, right? I was all risk all the time and very few stable assets. Today, I don't want to take that risk, right? If things go south, I want to make sure that I'm good. Now, the other benefit of the barbell in your portfolio is that if I know whatever happens in the market, I'm going to be okay because on the stable side, I've got some bomb-proof, time-tested assets like gold, land, and cash. What happens in a market crash is that while everybody else is freaking out and panic buying and panic selling, I have a new option. I can choose to do nothing because I know that my exposure to that volatility is limited and I've got this nice safety net over here that's going to keep me safe, right? So in a crisis, everybody reacts. Everybody moves fast. They make quick decisions. They think short term and they make mistakes, right? What the barbell does for me is give me the ability to be patient, sit back and do nothing when a market crash occurs or when a market goes parabolic, right? When prices start running, right? I can sit back and just be patient. Does that make sense? Okay. So last thing I'll mention on this piece right here is that the whole value of a barbell is duration, right? It keeps you at the table. If you're wrong on the investment side, you're going to be okay because you've built out the protective side, right? Defense and offense. And duration is what wins in this game. If you look at any of the legendary investors in this business or outside of it, individuals like Rick Rule, if you're familiar with that name, you know, he is the legend in this business that he is because He's been an investor in this business for 45 years, right? He stayed at the table for a really long time. Warren Buffett is the Oracle of Omaha because he's been an investor for over 80 years, right? If he had started his investment career when he was 30 and quit when he was 65, like most people, he'd be worth less than 1% of his current net worth, and none of us would have ever heard his name. Now, he still would have made himself a lot of money, but the reason he's a household name is because of duration. He stuck around in the markets for 80 years. It's the same reason that the number one asset most investors ever end up owning is their principal residence, their house. It's not because real estate's always the top performing asset. It's because that's the one asset that they hold for 25 years and don't try to trade, right? Duration wins. That's why. So what the barbell does for me is allow me to step back and be patient. Rule number 3, build your team. Okay, so we all know the analogy, you are the average of the 5 people you spend the most time with. Mentors are really, really important. And in this business, they are as well. Now, the advantage that we have in today's age is that you can build your tribe of mentors with any authors, podcasters, YouTubers that you want to, because everybody is creating so much content. And so every investor should go out and build their tribe, build their personal team of counsel, right? You don't have to know them personally, just podcasters, authors, investment managers that are putting out content, all of this. Now, when you're looking at assembling your stable of personalities that you're going to keep going back to and learning from, here's a couple things that have helped me. Number 1, you want to find individuals that communicate in a way that resonates with you. Their communication style is one that you enjoy, right? Learning from, right? Because if you don't enjoy the learning process, you're not going to keep going back to the trough. If the learning process is arduous and the content is too complex or technical for you to really wrap your mind around, you're not going to be excited to go back every day. And back to our first slide, right? How much time do you have to invest in being an investor? Not today, but every day, because investing is like anything. You don't hit the gym today and get jacked tomorrow. You got to build this into your lifestyle and let it compound over time. Learning is just the same. So you want to find personalities that are fun, right? Who put out content that you enjoy listening to, reading, or watching, because that's the only way you're going to go back. And when you enjoy something, you just retain more, obviously. Now, hypercritical that when you find, and I do recommend going back to the same people, by the way. I mean, you could just pick a new guru every day of the week. But frankly, going back to the same personalities allows you to understand how they think about the market. It allows you to understand when they're right, why they're right, when they're wrong, why they were wrong, what they missed, right? And helps frame your own thinking if you go back to the same brain, right, consistently and follow their journey for an extended period of time. I found that to be very, very beneficial. And on that same page, you want to look at the personalities that you're listening to and make sure you've also got somebody on the other side of that argument. So if you've got some personalities that are bullish on junior mining or the gold sector, make sure you find some that are bearish. Because if you trap yourself in the vacuum and in your own echo chamber, you're the one that gets whacked, right? You want to make sure you're hearing both sides of every argument. One little caveat I'll add to this, and it's kind of controversial, it might get me in trouble at this show, is I tell people to beware of the guru. Now, there's a lot of money to be made in financial media publishing. And I would just say, as a general rule of thumb, if the publisher is selling content and the brand name is tied to a specific asset, since this is a mining conference, we're going to pick on crypto. Let's say this is the Crypto Speculator investment newsletter. What is the probability that the Crypto Speculator writer is ever going to write you a letter that says, you know what? It's time to sell everything. This market's going to shit for the next 5 years, right? Look somewhere else. If their brand is the Crypto Speculator, they're never going to do that because it's horrible for business, all right? They will tell you what they need to tell you to keep you interested in what they're selling, right? It's a general rule. It's not an absolute truth, right? But I like this rule, and as a consequence, I prefer individuals who publish under their own name and never marry an asset class, because there's a good time and a bad time to buy everything, right? You want to buy when it's good. You don't want to buy when it's bad, all right? Junior mining the same, gold, crypto, real estate. There's a good time to enter and a good time to sell, all right? So as a consequence, I like people who publish under their own name, because what they're willing to protect, or what they're trying to protect, is their reputation, not your interest in a specific thing that they have to promote. Rule number 4, and this is specific to the junior mining community, but it's expands maybe to the startup community in general. I invest in a lot of emerging tech, and I find that this rule has helped me. So out here we have 240 junior mining companies right now, and they're all exploring for certain mineral, some part of the world. Now I can't, back to my competitive advantage, I can't be a geologist and a mining engineer and a jurisdictional risk expert, right? And a technical analyst. I can't compete, in all of those places, right? So how do I determine of these 240, which are the ones that I should focus on? So I reduce this to who has the best people, and that's all I focus on. I put absolute blinders on, I reduce everything else about the company, and I say who's running the show. Because companies at this size, whether it's junior mining or venture tech, small businesses, you're not investing in the industry. You're not investing in the service or the product. You're investing in the integrity and decision-making of like one or two human beings. So that's what you should do your research on. It's all about the people over everything, all right? The beauty of this is that anybody can become an expert in people, and anybody can do diligence on people, because we can find out who's the CEO. Okay, you're the CEO of XYZ company today. What were you doing 3 years ago? What were you doing 5 years ago, 10 years ago? And do they have a track record of success? They're telling you, we're gonna build this company to X valuation and sell it. Okay, have you ever done that before I let you have an adventure with my money? Now, I'm not adverse to betting on the rookie. I mean, most of my career, I've been the rookie soliciting bets, but when it comes to my investment dollars, I wanna bet on winners, because success begets more success, and winners attract other winners. In that workshop over there right now, it's probably where you should be. Ross Beattie's on stage. Ross Beattie is one of the most successful entrepreneurs ever in the mining business. He has built 15 companies and 15 times delivered a 10x return for his shareholders, all right? So when Ross starts a new deal, am I interested? Like, yeah, super interested, right? He's the broken slot machine. Now, you don't find many like Ross. You don't find any more like Ross, but you can look at the track record of CEOs and say, what were you doing before this business? Have you run 3 or 4 or 5 companies and you're just continually raising a bit of money, paying some salaries, moving on to the next thing? Are you a lifestyle CEO, or do you build and sell things, right? I wanna know, and I wanna follow that track record. Now, the benefit to getting the people right is that all that other stuff, are in mining, for example, are the rocks right? Well, good people are gonna have the best geologists in the world, right? Is the jurisdiction risky? Well, good people are gonna have the best geopolitical analysts in the world, and they're gonna build out their team accordingly. If you find the CEOs that consistently win, you'll find other winners on their board of advisors and board of directors. And I spread this out past just the CEO, by the way. I look at the board of directors, I look at the board of advisors, and I wanna look at everybody's resume and find out what they were doing before this venture, right? And if you find success, you usually find it on a bunch of people, not just 1 or 2. Last rule. Rule number 5, follow the smartest money. So this is admittedly a kitschy hack that I started using when I began investing in this industry. And so the reason I built this into my decision-making was because there's 240 companies out there. And how am I supposed to know, which are worth my attention? Let's just assume if you have 100 investment opportunities on your desk, that 90 probably are not worth your time. I mean, let's just be frank. You'd prefer to just expedite your focus to the top 10%, right? I mean, obviously you'd want to do that. A lot harder to do that in reality. So what this hack did for me when I started is I created a list of about 25 legendary junior mining investors. Individuals like Thomas Kaplan, Rick Rule, Eric Sprott, Frank Justra. And then I created Google alerts for all of these names. I mean, these are the individuals that have made hundreds of millions and billions of dollars investing in this business. So when I started, I just wanted to know what they were doing all of the time. And so I had about 30 Google alerts, and every time Eric Sprott wrote a check into a company, the company would inevitably press release this, and I would get an email, right? It wouldn't give me conclusive direction about where I should go, but it would tell me where the smartest money in the business was going. And over time, I could start to develop trends and patterns. It's like, oh, they all seem to gravitate towards companies like this. And quite frankly, this is how I got to my people over everything rule, because that was without question the most common denominator that I saw the smartest money using as their key decision-making process. I wrote this keynote out in long form. If you would like to read it, just go to myneweBook.com and you can download a copy absolutely free. 5 simple rules for every resource investor. All right, thanks so much.